Red alert means you stop staring at 5-minute charts, you stop worshiping indicators, and you stop confusing noise for truth. What is unfolding right now is not a pullback, not a reset, not an opportunity to scalp a few points. This is a structural break. This is the opening salvo of a financial war, and today marks the moment when the Western Front officially cracked. History will not remember the candles on your screen. It will remember who understood the signal when the system blinked. For years, a small group of us stood outside the cathedral of mainstream finance, warning that the price of silver was a fiction, that vaults were emptier than advertised, and that the largest banks on earth were leaning on a trade they could never unwind. We were dismissed, mocked, labeled alarmists. The narrative was simple: forget metals, buy growth, trust the system. That narrative died this morning. Because today, one of the most powerful and consistently bearish institutions in global finance quietly surrendered. Not a blogger, not a fringe analyst, one of the pillars of the Western banking system, the same institution that spent a decade telling clients to avoid gold and silver like a disease, just admitted in writing that everything has changed. When the loudest skeptic flips sides, it's not an opinion shift, it's a survival move. This is the moment every major bull market waits for capitulation. The instant when resistance turns into pursuit, when denial collapses into panic, and when the smartest money stops fighting reality. This is not bullish enthusiasm. This is fear with a spreadsheet. And fear backed by math is the most dangerous force in markets. If you feel tension right now, good. That discomfort is clarity arriving, because once the biggest bear becomes the loudest bull, there are no sellers left, only a vacuum. And the people who understand that first are the ones who don't need permission later. This chapter isn't about price. It's about power shifting hands. If this perspective resonates, press 1 in the comments to let me know you're still here. Subscribe to the channel so you don't miss what comes next. And if you're not ready to continue, press 2. To understand why this moment matters, you must understand who just blinked. This was not a minor adjustment from a neutral observer. This was a reversal from an institution that has spent years standing firmly on the opposite side of this trade. For over a decade, they told clients gold was overpriced, silver was irrelevant, and hard assets were a distraction from real investing. When a player like that changes direction, it is never philosophical. It is forced. What they admitted was not optimism, it was exposure. For years, gold above $2,000 was dismissed as unsustainable. Now, that same institution projects an average price more than double previous highs. That alone is a red flag. Moves of that magnitude do not happen inside a stable monetary system. They only happen when confidence in paper is quietly breaking. But gold was not the real confession. Gold has always been tolerated as a hedge. Silver was the line they refused to cross, until now. When they finally ran the ratios, the supply math, and the geological constraints, they reached an uncomfortable conclusion: silver is not slightly undervalued, it is structurally mispriced. Not by sentiment, but by physics. They did not present it as a trade. They framed it as necessity. Different historical benchmarks, different assumptions, same result. The current price cannot exist if delivery matters. That kind of language does not come from excitement, it comes from pressure. The shift from 5% allocations to discussions of 20 or 30% is not portfolio optimization. It is an insurance policy. It signals that confidence in stocks and bonds is deteriorating behind closed doors. Institutions do not warn the public first. They reposition quietly and explain later. This is how regime changes begin. Not with panic, but with silent acknowledgement. By the time the crowd agrees something is wrong, the math has already won. Now we get to the real question. Why now? Why does this reversal happen at this exact moment after years of denial and suppression? Banks do not change their minds out of curiosity. They change when the data becomes impossible to ignore and when the consequences of staying wrong become fatal. The timing tells you everything you need to know. The paper market only functions as long as confidence holds. As long as contracts can be rolled, settled, and disguised as liquidity, the illusion survives. But that illusion depends on one critical assumption, that physical supply exists somewhere in the background. Not visible, not advertised, but available. That assumption is now breaking. In the same reports that upgraded precious metals, there was a quiet acknowledgement that should terrify anyone paying attention. Global silver production is shrinking, not stabilizing, not growing. Shrinking. A contraction of even 2% may sound trivial in financial terms, but in commodity markets it is devastating. Supply does not flex easily. Mines do not respond to price the way factories respond to demand. Costs are rising everywhere. Energy, labor, equipment regulation. The all-in cost to extract silver has surged to levels that make many operations barely viable. At lower prices, producers survive, but they do not expand. And without expansion, the system slowly starves itself. Here is the trap. The financial system assumes price solves everything. Raise the price and supply appears. But geology does not respond to incentives on a quarterly schedule. You cannot print ore. You cannot accelerate time. When supply falls while demand quietly grows, pressure builds invisibly until it snaps. This is what institutions are seeing now. The realization that suppression no longer buys time, that every paper contract issued increases future risk, that the game only works until someone asks for delivery and finds an empty shelf. So the reversal is not strategic. It is defensive. The goal is no longer to control price. It is to survive repricing. And once survival becomes the priority, the rules change fast. While Western institutions were still adjusting spreadsheets and rewriting research notes, something far more powerful was already in motion. The real pressure was not coming from New York or London. It was coming from the East. And this is the part of the story most investors completely underestimate. China is not reacting to markets. China is executing a strategy. While Western media debates rate cuts and decimal points in unemployment data, Beijing detonated a liquidity event so large it distorts global gravity. This was not stimulus in the traditional sense. It was a monetary weapon. The expansion of China's money supply was not incremental. It was explosive. An injection so massive that comparisons almost lose meaning. But the key difference is not the size. It is the destination. When Western governments print liquidity flows into equities, derivatives, and financial engineering, when China prints, it flows into things you can touch. This liquidity is not chasing stock prices. It is converting paper into resources, oil, copper, food, and most aggressively precious metals. This is not speculation. It is balance sheet transformation. A deliberate exchange of depreciating currency for assets with no counterparty risk. This is why the currency has not collapsed the way textbooks predict. It is being quietly anchored by what is being accumulated. Commodities are acting as a stabilizer, absorbing the shock while draining global inventories. What looks stable on the surface is hollowing out supply underneath. From the Western perspective, this is catastrophic. An unlimited buyer has entered the market indifferent to price, focused only on volume. Every dip is absorbed. Every attempt to suppress is met with demand that cannot be outprinted. This is the force that broke resistance. No trading desk can compete with a sovereign balance sheet that prints without constraint and buys without hesitation. When institutions saw this, they understood something critical. The paper market no longer sets the rules. Physical flow does. Once that realization sets in, the game is over. Not slowly, suddenly. This is where the math turns from uncomfortable to impossible. Because while demand from the East is accelerating, the West is trapped on the opposite side of the trade. For years, large financial institutions treated silver as an abstract number, something that could be sold infinitely on paper without consequence. That assumption created one of the most dangerous positions in modern finance. The scale matters, not millions, billions. Estimates of the combined short exposure held by Western banks reach levels that defy intuition. Paper promises representing multiple years of global production were sold into existence under the belief that they would never need to be honored in physical form. This works only in a world where nobody asks questions. Now the questions are being asked. Global mine production sits at a hard ceiling, roughly 800 million ounces a year spread across the entire planet. That is not a forecast, that is geology. You cannot negotiate with it. When paper claims exceed real output by several multiples, the system becomes fragile by definition. Every dollar move higher compounds the problem. Losses accelerate. Risk managers panic. What was once a controlled strategy turns into a runaway obligation. And unlike stocks or bonds, silver is not optional. A short position is a promise. Eventually, someone stands for delivery. Here is the nightmare scenario institutions are now modeling. Industrial users do not accept cash settlement. Governments do not accept apologies. When delivery is demanded and inventories are insufficient, price stops behaving like a market and starts behaving like a signal flare. At that point, sellers vanish. Bids chase air, and the entities that spent decades suppressing price are forced to become buyers at any cost. That is how vertical moves happen, not from excitement, but from desperation. This is why the tone has shifted. This is why forecasts suddenly look extreme. The math no longer allows gradual adjustment. It demands resolution. This is where perception becomes the weapon. When institutions realize they are cornered, they do not capitulate publicly all at once. They try one last maneuver. They attempt to manufacture an illusion of resolution, a price that looks high enough to trigger selling, but low enough to relieve pressure. This is the trap phase. What you see on a screen is not the market. It is a reference. A paper quote derived from futures contracts traded during narrow windows dominated by algorithms designed to influence behavior, not reflect reality. The real market exists outside that screen, where metal changes hands, where inventory matters, and where supply is either available or it is not. This is why the disconnect is growing. Premiums are not rising because demand is emotional. They are rising because inventory is gone. In a functioning market, price gaps close through arbitrage. Paper buyers take delivery and sell physical. That mechanism is breaking. When it breaks, the reference price becomes fiction. This is the moment designed to confuse participants. Green candles create relief. Round numbers create comfort. They want you to believe the move has already happened, that the risk is gone, that now is the time to take profits and step aside. This is not generosity, it is necessity. Liquidity must be coaxed back into the system. Physical metal must be shaken loose from strong hands. The only way to do that is to make the price look attractive enough to sell, but attractive compared to what? Compared to yesterday's illusion. The danger is psychological. Humans anchor to familiar numbers. If something traded at 20 for years, 80 feels expensive, but value is not measured against the past. It is measured against the system it must replace. And that system is failing in real time. This phase does not last long. Once confidence in the reference price erodes, behavior flips. People stop asking how much and start asking if any is left. That is when repricing accelerates. At this stage, the market stops behaving like a market and starts behaving like a countdown. What matters is no longer momentum or indicators, but availability. The conversation shifts from charts to inventory, from targets to access. This is the phase where paper and physical finally separate. When physical buyers step in, they are not price sensitive. They are outcome sensitive. Industrial users, governments, and strategic stockpilers do not negotiate with screens. They secure supply. And once that supply is secured, it does not come back. This is why every pullback feels weaker than the last, and every recovery establishes a higher floor. Western financial structures were built on the assumption that everything could be financialized, that real assets could be replaced with derivatives, and that leverage could substitute for possession. That assumption holds only until the underlying asset becomes scarce. Scarcity exposes leverage instantly. Once the physical market tightens beyond a certain threshold, futures lose authority. Cash settlement replaces delivery. Confidence erodes, and the reference price loses credibility. When that happens, the repricing is not linear, it is abrupt. This is not unprecedented. Similar dynamics have played out in other metals when supply shocks collided with leverage. The pattern is always the same: calm tension denial, then a violent adjustment that leaves no time to react. By the time headlines appear, the move is already over. This is why patience becomes a strategic advantage. Those who understand the structure do not trade the noise. They wait. They let the pressure build. Because the final move is never announced in advance. It arrives when positioning becomes untenable. This is not about predicting a top. It is about recognizing a floor that keeps rising because the underlying reality keeps tightening. And once that reality asserts itself, the old rules no longer apply. Now we confront the part of this cycle that most people misunderstand: time. Markets train participants to think in days, weeks, quarters, but scarcity operates on a different clock. Once inventories are depleted, time stops being a friend and starts becoming an enemy. Delays compound damage. Every day without supply tightens the noose. Mining cannot respond fast enough to matter. Even if prices double tomorrow, nothing meaningful changes next month or next year. New discoveries take years. Permits take longer. Capital takes confidence, and confidence disappears during monetary transitions. This creates a paradox where higher prices do not immediately bring relief. They bring stress. Demand accelerates faster than supply can react. At the same time, industrial dependence quietly locks in consumption. Energy systems, electronics, defense, infrastructure, and emerging technologies cannot substitute easily. When usage is structural, not discretionary, demand becomes inelastic. Buyers do not step aside, they compete. This is where the pressure becomes systemic. Shortages in one sector bleed into others. Supply chains tighten, governments intervene, strategic reserves are reevaluated. What began as a market imbalance evolves into a policy concern, and policy responses are rarely gentle. The mistake is assuming this process is orderly. It is not. Transitions between monetary regimes never are. They are volatile, uneven, and unforgiving to those who wait for clarity. Clarity only arrives after repricing has already occurred. This is why complacency is dangerous right now. The system still appears functional, prices still update, trades still clear. But beneath the surface, buffers are gone, redundancy has been consumed, there is no slack left to absorb shock. When the final adjustment comes, it will not ask for consensus, it will reflect necessity. And necessity does not negotiate, it redefines value overnight. At this point, everything converges. Liquidity expansion, structural shortages, leverage, and psychology collide in the same narrow window. This is where markets stop debating probabilities and start enforcing outcomes. The remaining question is not whether repricing happens, but who is positioned when it does. The system is built on confidence, confidence that contracts will be honored, that settlement will be smooth, that supply will appear when needed. When that confidence fractures, behavior changes instantly. Participants rush not for returns, but for certainty. They abandon promises and seek possession. This is the moment institutions fear most. Because once the shift occurs, control evaporates. There is no lever to pull, no rate to adjust, no communication strategy that restores trust. Price becomes the clearing mechanism of last resort. In this environment, hesitation is punished. Waiting for confirmation means paying exponentially more later or being locked out entirely. History is consistent on this point. The largest gains accrue not to those who time perfectly, but to those who recognize structural imbalance before it becomes visible. The irony is that by the time risk feels obvious, opportunity is gone. The crowd arrives late, chasing headlines, chasing momentum, competing for scraps. Those who prepared early are already immobile, insulated from the chaos. This is not about panic buying or speculation. It is about alignment. Aligning with scarcity, with physics, with incentives that cannot be reversed by policy. Once that alignment is achieved, patience replaces anxiety. The final adjustment does not reward intelligence, it rewards positioning. And positioning must be established before consensus forms. That window is narrowing. This is where we stop observing and start extracting lessons. Every cycle leaves behind wreckage, but it all leaves behind clarity. The lesson of this moment is not about silver alone. It is about understanding how power, scarcity, and leverage interact when a system reaches its limits. Markets do not fail because of emotion. They fail because assumptions expire. The first lesson is simple. Price is not value. Price is a reference point created by the most liquid venue, not the most honest one. When liquidity is artificial and supply is real, price eventually surrenders to reality. Those who confuse the two give up real assets for fading promises. The second lesson is patience. Structural moves do not reward speed, they reward conviction. The people who win these cycles are not the loudest or the fastest. They are the ones who understood early and refused to be shaken out when volatility was used as a weapon. The third lesson is positioning over prediction. You do not need to know the exact day or number. You need to know the direction and the constraints. Scarcity rising costs and inelastic demand are not opinions. They are conditions. When conditions align, outcomes follow. Finally, the most important lesson. Systems change quietly, then suddenly. By the time certainty arrives, access is gone. The window does not close with an announcement. It closes with empty shelves. So the strategy from here is discipline. Do not chase noise. Do not trade core protection for short-term comfort. Do not let temporary price references